Hey guys, welcome back to the New Vision channel, where we talk about all things real estate. In this video, we are continuing the series on real estate bookkeeping and the importance of this topic in your new business. We are making the assumption here that you may not have a bookkeeper at the beginning of your business, and that you are likely going to do this function yourself to avoid the insanity of boxes of receipts lying around at the end of the year. And even if you can afford a bookkeeper in the beginning of your business, you would still need to understand what your bookkeeper is doing. Many people think of bookkeeping and accounting as though it was only for tax purposes. They could not be more wrong. At its heart, accounting is the language of business, and if you are going to be successful in it, you would do well to understand this language. In the last video, we talked about all the main categories or accounting buckets that you would need to hold your business transactions. These are the assets, income, liabilities, expenses, and the owner's equity. We also covered some of the main subcategories for each of these major categories that would hold the details of each business transaction. Once these subcategories of accounts are properly established, your job as a bookkeeper is to properly enter each transaction into your accounting system, so that at the point in time when you switch hearts over to becoming an entrepreneur and owner of the business, you can easily see and monitor the health of your business by seeing the flows of resources into and out of your business. In this video, we are going to cover the concept of flows, which comes from the observation that money cannot simply appear or disappear from your business. It has to come from somewhere and go somewhere, hence the flows. To do a good job in bookkeeping is to ask and then answer the question where value is coming from and where it's going. For example, we show here how rent flows from your tenant, who's your customer, and eventually into the bank account of your business through the income checkpoint. Of course, there are many different types of money flows that will make up the entirety of your business transactions, and we show some of the main ones here. In his famous book, Rich Dad Poor Dad, Robert Kiyosaki talks about understanding this concept of flows as the foundation of your financial education. In its simplest form, you need to understand where money is coming from and where it's going to. Lack of this understanding is the road to the poorhouse and potential ruin for your new business. So, beyond just keeping good records for tax purposes, your job as a business owner is to monitor these flows and use this information to properly plan and manage a healthy business. Any good business is one that is designed to generate lots of revenue or income at minimal expenses, so that what is left over can be used to reinvest in the business, which hopefully would produce more profits or hand it over to owners as dividends. Now, sometimes, to get to the desired revenue, you may want some debt. But before you take on any debt to invest in your business, which we know is a liability, you want to make sure that the revenue that will come in is large enough to service the debt, pay the operating expenses of the business, and also have a profit that can be used to pay the owners, that's yourself, or further grow the business. One of the things that cause many new real estate investors to struggle or eventually fail in their investments is the lack of this kind of knowledge or planning. For example, if the first house you bought does not produce enough rent income to cover the expenses needed to maintain the property, before long, you will either need to come up with more money from your pocket or borrow more money in order to keep the house. If you fail, then your house will surely go into disrepair, and before long, you lose your tenant and may not be able to find a new one, which makes the problem worse because now you have no income but still have fixed expenses to run the house. This is one of the reasons why new investors are always cautioned to have more reserves, especially for those expenses that might come as a surprise. Or even if you are an experienced investor, and when things are going well, you decide to over-leverage your business by taking on too much debt. And suddenly, there is a downturn in the economy causing rent income to drop, and you are not able to service the debt that you have taken for the business and still have enough to pay for the operating expenses of the business. Then you can either have the lenders foreclose on your business or let your business go into, or your buildings go into disrepair. Or even be forced to put more money into the business from your pocket. These are all not good options and can be avoided by planning for and monitoring all these sources and destinations of money within your business. It all starts with proper bookkeeping. Please let us know in the comments below if you find this type of content helpful. You would be encouraging us to create more by subscribing to our channel and clicking on the notification button so that you will immediately know when we put out new content. Many thanks and see you in the next video.